In this video, I'm going to tell you why I sold 3M from my dividend growth portfolio, what stock I picked to replace it, and how those moves impact my portfolio. Hi, I'm Dave Van Nap with the Dividends and Income channel. Before I get going, please help us out by giving this video a thumb up if you appreciate the content, subscribing to our channel, and ringing the bell to get notifications when we post new videos to the channel, which is about once a day. I'm devoting attention this year to the small positions in my dividend growth portfolio, by which I mean those that make up less than 3% of the portfolio. In January, you may recall that I got rid of Chevron, which I covered in a video dated January 23rd, if you want to find out more about that. And now in February, I have replaced 3M, and I want to tell you why. The main reason that I sold 3M is the declining size of the company's dividend increases. This is a 10-year chart, and it plots on the purple line 3M's dividend increases over the last 10 years. And I've circled the last 3 increases at the right side of the chart, and you can see how small they've gotten. This chart now just shows the last 3 dividend increases. They look larger because the chart has been rescaled, but they're actually quite small. And I've circled on the right that the total of the last 3 increases from 3M have totaled just a little over 3% in total, not each one, but 3% total over the last 3 years. Beyond the lousy dividend increases, 3M's price has been dropping like an anchor since last June. This chart goes back to early in February of 2019, which is when I first bought my 3M shares. And you can see that overall the price is down from when I bought it, even though it had been going up nicely after the COVID crash. But after peaking last June, 3M's price has basically slid straight down, and it has now reached the point where it was down 13% overall from the time that I bought it back in 2019. I have a set of selling guidelines in my business plan for this portfolio, and to be honest, I didn't have a guideline covering this particular situation of declining dividend increases that got so small that you could hardly see them, coupled with a falling price. However, for the last couple of years, in addition to my written selling guidelines, I've been playing around with a mental category for this kind of holding. I call it "You Piss Me Off." This category is utterly informal, but I know it when I see it. 3M has been walking on the edge of YPMO for several months, and on Friday, February 18th, after I stewed about the 0.7% dividend increase this year, on top of everything else going on with 3M, it officially entered YPMO status for me. Now, I hadn't thought about putting a YPMO guideline in my business plan, but on the other hand, in the interest of good portfolio management, I don't want to make emotional decisions either. So I have added this guideline for seriously considering selling to the other guidelines that were already there. Under the new guideline, I will seriously consider selling a stock if it, and this is the way the guideline reads, registers performance well short of expectations over an extended period of time of at least a year. Notice that I worded the guideline in terms of performance being well short of expectations. Performance in this case can apply either to price performance, dividend performance, or both. And in 3M's case, it's both. The bottom line for me is that on Friday, February 18th, I sold all of my 3M. In replacing 3M, I was not looking to duplicate its sector, which is industrials, or replicate its yield. My main focus was on replacing most of its income and on getting a quality stock with a much better dividend growth record than 3M has been displaying over the last 3 increases. It's Crown Castle Incorporated, ticker symbol CCI. This slide is from a recent investor presentation by Crown Castle, and it shows what business they're in, which is telecommunications, cell towers, what are called small cell installations, and they own 80,000 miles of fiber optic cabling. The map, while it's hard to read, shows you the extensiveness of Crown Castle's growing network supporting of real estate and real estate assets that support telecommunications, and how, as you would expect, they're centered mostly around the large population centers in the United States. Okay, here's Crown Castle in a nutshell. They're in the real estate sector. Specifically, their industry is called specialized REITs, and in this case, the specialty is in technology and communications. Across the middle of the slide, I have shown the final grades for things that I normally grade when I do a deep dive on a stock. I'm not going to show the detail behind all of these things because it would be too boring, but I want to show you the final grade. And in the case of dividends, I show a little bit of the detail across the bottom. On dividends, I give Crown Castle a B, and you can see that it has a yield of 3.6%, which is pretty good. It's higher than the yield of my portfolio. A 5-year dividend growth rate of 9% a year, which is way better than 3M's was, if you remember what that looked like. And last year in November was their most recent increase, and it clocked in at 11%. And in the lower right, the Simply Safe Dividend Safety Score of 61 is in the second highest tier of SSD scores, and it indicates that they think that the dividend is safe, unlikely to be cut. Quality, using my quality snapshot approach, I give 18 out of 25 points, or a C plus, to Crown Castle. Good, solid, investable company. Financials get a C, not overwhelmingly good, but not bad for a young real estate investment trust. I figure the Crown Castle at this point is a little overvalued, 14% overvalued, but I like the yield, which hasn't been affected too much by that, and I certainly like the dividend growth rate. So I did something that I normally don't do in making this purchase, which is I purchased shares in a company that I consider to be a little overvalued at its price. And in the far right middle there, I looked at Wall Street. There are 20 analysts that are covering Crown Castle at the moment, and if you average out their recommendations or their conclusions on a 0 to 5 or 1 to 5 scale, typical in Wall Street, you end up with a score of 3.6 on a scale of where 3 equals hold and 4 equals buy, so it just edges over into the buy side. When you round it, I call it, in this chart, I call it buy/hold. Let's return now to a little more of a deeper look at the dividend situation between 3M and Crown Castle, and I think it'll become clear why I chose Crown Castle to replace 3M. Don't get scared by this slide. It's actually pretty easy to figure out, and I'll walk you through it. This focuses on just the dividend records of the two companies that I'm talking about. The metrics that I look at are listed down the left side. I want to highlight a few of them. The yield we've already seen. 3M has a 4.0% yield. Crown Castle's is 3.6%. Remember, I said I didn't want to try and replace all of the income from 3M. I just wanted to come close, and that Crown Castle does that here. 3M is a dividend champion, a dividend aristocrat, and what is called a dividend king. It's increased its dividend for more than 60 years. Crown Castle doesn't play in that league yet, but it has increased its dividend for every year of its existence, which is 7 years. The next two lines on the slide cover dividend growth for the two companies over various time frames. You can see that the 5-year dividend growth rate for 3M has been 6% a year, which isn't bad, but CCI's is higher at 9% a year. If you reduce the time frame to 3 years, 3M, as we saw in that earlier chart, is at 3% a year. Crown Castle is at 9% a year. The most recent increase, the one that entered YPMO territory for me, for 3M, was 0.7%. They just announced that in February, while for CCI, it's 10.5%, which they announced in December of last year, and their next increase will be December of this year. So that's a huge advantage of Crown Castle over 3M. And if you eyeball the dividend growth trend, which I do when I'm doing a deep dive on a stock, what we see with 3M is that its stock increases have been declining pretty steadily over the last 10 years. 10 years ago, they had a 10% per year growth streak going, and that has steadily declined, as we've seen, to less than 1% this year, whereas CCI's increases have been steadily in the 8% to 10% range per year since they started paying dividends 7 years ago. And finally, we've already seen the dividend safety score for the companies at 75 out of 100 for 3M, which is good. Crown Castle's is less than that on points, but it's still in the same second tier of categories from Simply Safe Dividends, which means that its dividend is considered to be safe. This graph reiterates some of what we've just seen. It shows covers the last 5 years, so it shows the last 5 increases for the two companies. And you can see that 3M, which is the purple line, if you add up the total increase, not the annual increases, but the total increases over the last 5 years, it comes out to like 27% total increase in the dividend. Crown Castle is nearly double that at 55%. And this slide is from Crown Castle's recent investor presentation, and it shows how their dividend has grown every year since they started. CAGR GR, which stands for Compound Annual Growth Rate of 9% a year from its 2014 dividend to its most recently increased dividend, which was at the end of 2021. So 2022's increase for Crown Castle is still in our future. Here are the transactions from selling 3M on February the 18th. Across the top, the 3M shares sold. I had held 18 shares, sold all of them, sold out of the position. For selling them, I got $2,671, and I lost $107 per year in annual dividend income. What did I do with that money? I bought 16 shares of Crown Castle, which is a new position, but it replaces 3M, so the total number of positions in the portfolio stays the same. That cost me $2,580 and will deliver me, as of current run rates, $94 a year in dividends from Crown Castle. I also had a little money left over. It wasn't enough to buy another share of Crown Castle, so I grabbed a share of the ETF SCHD, increasing by 1 the number of shares I owned to 26. That costs $77, and it adds another couple bucks to the annual dividend run rate. At the bottom, the total impact of these 3 transactions was I had $14 left over, which I'll roll into next month's dividend reinvestment in March, and my annual dividend rate for the whole portfolio fell by $11 per year. I timed this sale and replacement to let me double dip on the first quarter dividend from both companies. So for 3M, whose shares I held until February 18th, the ex-dividend date was February 17th, on which day I held the shares, so I will get 3M's first quarter dividend. Then I turned around and bought the shares of Crown Castle, and their ex-dividend date is not until March 24th. And of course I will own the shares on that date, and that will make me eligible for Crown Castle's first quarter dividend when they pay it later in March. So the end result is that for the first quarter, I'll collect an extra $25 in dividends over what I would have collected had I simply held on to 3M, which more than makes up for the $11 loss in annual dividend run rate. And by the end of the year, when Crown Castle increases its dividend, I will have wiped out that $11 deficit easily going forward. Okay, I want to finish out with this slide, which talks about the 3 ways you've heard me talk about the 3 reasons that the dividend income in a dividend growth portfolio goes up. 1 is dividend increases from the companies. 2 is a reinvestment of the dividends, which I do in the middle of every month. And 3 is occasional portfolio changes. What we've talked about today is an example of that third category. And this table sums up what I've done in that area, in the area of making adjustments to my portfolio this year. And I'll continue to track changes throughout the year if I make any more. I may not make any more, who knows. In January, as I mentioned earlier, I sold out of Chevron. And now in February, I have sold out of 3M. And this shows the cash value, $2,671. Shows that I replaced 3M with 16 shares of Crown Castle and 1 share of SCHD, which resulted in an 11% diminished amount of my annual dividend run rate, which I don't worry about at all. The 2022 total of changes to the portfolio, I've swapped out $6,500 worth of shares so far this year, and the impact on the dividend run rate has been negligible, but I have picked up better dividend increase rates, and I think improve the overall quality of my portfolio in making these changes. And that completes this video. There are 2 main takeaways here. 1 is about the process of portfolio management itself, and number 2 is about the merits of Crown Castle as a potential dividend growth investment for any of you. I think pretty highly of it right now. That's why I bought it. Please remember to click the buttons, subscribe to the channel, get the notifications and so on, and give the content a thumb up if you enjoyed this. And with that, I will say see you next time, and so long, everybody. Bye.